Hello Forex Pro family, let me ask you a question. The stop loss safety net, it's a friend or foe? You've placed your Forex trade, carefully analyzing the market trends and making your move. You're excited about the potential profit, envisioning the gains you could make. But what happens if the market moves against you, turning your excitement into anxiety? How do you protect yourself from massive losses that could wipe out your investment? That's where a stop loss order comes in. It's your safety net, designed to limit your losses. But what if this safety net is actually a trap, a double-edged sword? What if someone is manipulating the market to trigger your stop loss, causing you to sell prematurely? This, my friends, is the dark art of stop loss hunting, a tactic used by some to exploit others. A stop loss order automatically sells your currency pair when it hits a certain price, executing the trade without your intervention. Think of it as an emergency exit, a way to escape a burning building. It limits your losses and protects your capital, ensuring you live to trade another day. It's a fundamental tool for every Forex trader, a must-have in your trading arsenal. However, just like any tool, it can be exploited if you're not careful. In the wrong hands, your stop-loss order can become a weapon used against you, turning your strategy into a liability. This is why understanding stop-loss hunting is crucial, a key part of your trading education. It's about protecting yourself and your profits in the cutthroat world of Forex trading, where every move counts. Stop-loss hunting, unveiling the predator. Imagine a predator stalking its prey. It knows exactly where the prey will go and lies in wait, ready to pounce. Stop-loss hunting is similar. Large institutional traders, often called market makers, act like predators. They target the stop-loss orders of smaller traders, like yourself. Stop-loss hunting is the manipulation of currency prices. These large players push prices down to trigger the stop-loss orders of unsuspecting traders. Once these orders are triggered, a cascade of selling occurs. This drives the price even lower. The result? You're forced out of your position at a loss, and the hunter walks away with a profit. But why go through all this trouble? Why not just trade normally? The answer lies in the mechanics of the market and the insatiable desire for profit. The mechanics of the hunt, how they push you over the edge. The Forex market is a battlefield of supply and demand. When someone sells a currency pair, someone else has to buy it. Market makers, with their enormous trading power, can influence this balance. They know where most traders place their stop-loss orders. These are often clustered around obvious support and resistance levels. By selling large amounts of a currency, market makers can push the price down to these levels. This triggers a chain reaction. Your stop-loss order is activated, selling your position. This selling further pushes the price down, triggering even more stop-loss orders. It's a domino effect, all orchestrated by the market maker. But this manipulation isn't just for fun, it's a calculated strategy for profit. The why behind the hunt. Profit and the liquidity chase. Market makers aren't charities. They're in the business of making money, and they have sophisticated strategies to ensure they do. Stop-loss hunting provides them with two key ingredients for profit. 1. Guaranteed orders. Stop-loss orders act like pre-placed buy or sell orders ready to be executed. This guarantees the market maker will find buyers or sellers for their positions, no matter how large or small. It's like having a guaranteed buyer for your product. 2. Liquidity. Liquidity refers to the ease with which a currency can be bought or sold without affecting its price significantly. Stop-loss hunting creates a surge in trading volume and liquidity, making the market more dynamic. This allows market makers to move in and out of positions quickly and profitably, capitalizing on the increased activity. Stop-loss hunting is a predatory practice, often seen as market manipulation. But understanding its mechanics and motivations empowers you to make better trading decisions. You can now take steps to avoid becoming the hunted, using strategies to protect your investments. Section 5. Don't be easy prey. Outsmarting the stop-loss hunters. You know the predator, you understand its tactics, Now it's time to fight back. The market is a battlefield, and you need to be prepared. Protecting yourself from stop-loss hunting isn't about avoiding stop-loss orders altogether. It's about using them wisely. It's about being smarter, more strategic. You need to think like a hunter, not the hunted. Here are some tactics to keep in mind. Avoid obvious levels. This is crucial. Don't place your stop-loss orders at obvious support and resistance levels. These are prime targets. These are easily identified by market makers and other traders. They know where to look. Instead, place your stops a bit further away from these levels. Make them less predictable. This adds an extra layer of security. Consider using wider stop-loss orders, especially in volatile markets. This can be a game changer. This gives your trade more breathing room and makes it harder for market makers to hunt your stop-loss. It's about survival. Remember, tighter stops might offer less potential loss, but they are easier targets. Balance is key. By using these strategies, you become a less appealing target for stop-loss hunters. Confidence comes from preparation, but there are even more tools you can add to your arsenal. Equip yourself with knowledge and stay ahead. Section 6. The wider stop-loss strategy. Expanding your safety zone. Think of your stop-loss order as a fence around your trade. A tight stop-loss is like a small fence close to your house. It's easy to jump over. A wider stop-loss is like a larger fence, further away. It's more difficult to cross. Wider stops are especially important in volatile markets. Volatility means prices can move quickly and unexpectedly. A tight stop-loss in a volatile market is almost guaranteed to get triggered, even if your trade idea is sound. Remember, the goal of a stop-loss is to limit your losses, not to dictate your every move. Give your trades room to breathe. Don't let market noise scare you out of a potentially profitable position. Section 7. The invisible shield. Mastering the mental stop-loss. Not all stop-loss orders need to be set in stone within your trading platform. A mental stop-loss is a powerful tool. It's a predetermined price level where you mentally commit to exiting a trade if it's reached. This strategy is particularly useful for those who suspect their stop-loss orders are being hunted. By not placing a physical stop-loss order, you remove the obvious target for market makers. However, mental stop-losses require discipline. You need to be firm in your decision to exit when your mental stop-loss is triggered. Don't let emotions lead to hesitation and bigger losses. Mental stop-losses can be combined with physical stops. Use them as a primary exit point while setting a wider physical stop-loss as a final safety net. Section 8. Diversification. Don't put all your eggs in one basket. Imagine placing all your trades on a single currency pair, with stop-loss orders clustered around the same level. This is like putting all your eggs in one basket, a very risky basket. Diversification is key to managing risk in Forex trading. Spread your trades across different currency pairs. Avoid placing your stop-loss orders at similar levels. This strategy makes you a less attractive target for stop-loss hunters. It makes it more difficult and less profitable for them to manipulate multiple currency pairs to trigger your stops. Section 9. Navigating the depths. Understanding market depth. Market depth, also known as the order book, provides valuable information about the liquidity of a currency pair at different price levels. It shows you the number of buy and sell orders queued at each price. By analyzing market depth, you can identify areas of high liquidity and potential stop-loss clusters. Avoid placing your stop-loss orders near large clusters of buy or sell orders. Some trading platforms offer tools to visualize market depth. Utilize these tools to your advantage. Understand the liquidity landscape before placing your stop-loss orders. Section 10. Conclusion. Knowledge is power in the Forex jungle. The Forex market can be a treacherous jungle, but with the right knowledge and tools, you can navigate it successfully. Stop-loss hunting is a reality in Forex trading, but it doesn't have to be your downfall. By understanding how it works, why it happens, and the strategies to avoid it, you can protect yourself and your profits. Remember, knowledge is power. The more you learn about the intricacies of the market, the better equipped you'll be to succeed. So, continue to learn, adapt, and evolve your trading strategies. The Forex market is constantly changing, and so should you. Good luck, and may your trades be profitable. Subscribe Forex Pro YouTube channel for your trading journey. Join Telegram, Facebook page from the description. Happy trading.